Now, today, you're going to get sick of me looking down at my notes a little bit today. What I wanted to do is give you an overall market update. I've been to a number of industry presentations this week. Those presentations are not open to the public, so I thought it would be good to share some of my insights from those presentations with you, to give you a bit of an insider's guide into what's happening within the industry and within the market and the overall economy. So, as I said, I went to a number of presentations this week. The first one was held by La Trobe Financial. They're one of the major construction and development finance lenders in the market within Australia. They had a number of associated parties there from valuation firms, etc. Now, some of the key takeaways I took out of their presentation was that one of the valuers mentioned that site values are starting to ease with cost escalations at the moment. So what does that mean? Construction costs are obviously increasing, and they're being driven by labour costs. It's particularly pertinent in Queensland at the moment. Well, in all capitals, really. Labour costs are going up because there's so much construction underway at the moment. There is a high demand for labour, which is driving those labour costs up. Now, when you consider that builders quite often are working on a 3, 4, 5% margin, and sometimes up to 80% of their costs are subcontractors, subbies. You can really see that they're getting very much squeezed there at the moment. So I guess the key takeaway there is to be very, very careful of your builder if you're doing some development going out of business. So there has been a number of cases recently that have been noted. So again, it just makes it super important to do your due diligence, particularly on your builder if you're undertaking any sort of development or you're buying off the plan, for example. Okay. One of the other presentations I went to was a great presentation from the MFAA, the Mortgage and Finance Association of Australia. That was their kick-off event up here in Brisbane. They had some great speakers there from NAB and from CoreLogic RP Data. So there's a couple of things, well, there's actually a lot of things here that I want to mention that are really relevant. Okay, having a look from the NAB presentation, first of all, they have noted there's a global growth slowdown, and that's obviously been widely reported in the media as well, particularly looking at China and those overseas power economies. What was really interesting is some of their forecasts for 2017. They're expecting the Australian dollar to come back down to around that 70 cent mark through 2016 and 2017. And their forecast for interest rates, well, the RBA rate to remain steady at that 2% for all of 2016, but then moving up to potentially 3%. Throughout 2017, so that was really interesting to note. So just to reiterate, they're looking at throughout 2016 no move, but 2017 a slight increase there. This one's really interesting from their survey, building approvals. So building approvals at the moment, when comparing houses and apartments, are basically 1 for 1. So we're building as many apartments as we are houses in 2016. 15 years ago, in 2001, that ratio was 3 to 1. So 3 houses to every apartment in terms of building approvals. So that really is a strong indication of how many apartments are being built. I think there's a number of reasons for that. I don't think we can just go blanket, there's a massive oversupply of apartments. I think there's definitely a change in preference as well for higher density living, and particularly speaking about Victoria in particular. I know in terms of the city plan and the state plan is to encourage that, and it's probably the same across all capital cities. Looking for that high density of living where existing infrastructure is. So you've probably seen a lot of construction around train stations and shopping centres, and that is the government plan. So that's been encouraged by the government in terms of their planning to create higher density regions. So you're not going to see masses and masses of development and new land further out where there's no infrastructure, because obviously that's very expensive for the government, to build new train lines and new train stations and things like that. They want to condense the population around that existing infrastructure. So, your public transport, your shops, your schools, that sort of thing. This one is everyone seems to be saying. Brisbane is expected to outperform the other capitals this year in terms of capital growth. But having said that, the expectation is only for potentially around 3 to 4% growth. So we're not expecting to see these masses of 10%, 20% growth. So let's not get carried away and keep it in perspective. However, they do see Brisbane outperforming the other capitals over the next 12 months. And you would have heard me previously speak about the property clock and the property cycle and where Brisbane or Queensland is in relation to those other capitals. One of the key drivers there is obviously the Australian dollar and the attractiveness of tourism, which is obviously a major employer here in Queensland. Okay, moving on now to some of the takeaways from the RP data, CoreLogic RP data presentation. Having a look at the cumulative capital gain post GFC for some of the capitals. Sydney has experienced 73%, Melbourne 66%, and Brisbane only 11%. So again, if we think around that property clock and that property cycle, it's really important to take note of that, where we think Sydney and Melbourne are and where Brisbane is at the moment. Brisbane obviously experienced that large growth spurt in the early 2000s and has been very, very subdued since the GFC, so that 2007-2008 timeframe. Again, looking at the last 12 months, so we're looking at cumulative capital gain here. This is in median price, obviously. Sydney at 10.5%, Melbourne at 11% over the last 12 months, and Brisbane down at 2.8%. You might have seen a few people speaking about Melbourne overtaking Sydney in terms of capital gain over the last 12 months, and that's been in the press a little bit over the last sort of week or so. This is a really interesting one, the affordability gap now between Sydney and Brisbane. So when we're looking at the median house price and looking in actual dollar terms, the difference between Sydney and Brisbane is now $310,000 in the median house price. So obviously affordability based on that measure is a lot better in Brisbane. The weather's better too. Speaking about Brisbane, and again, I apologise if this is a little bit Brisbane-centric, but the presentation was in Brisbane. The average vendor discount, so in Brisbane, unlike Melbourne and Sydney, auctions are very, very, not rare, but there aren't many auctions at all. Overwhelmingly, private treaty is the predominant sale method. So a good indicator of the market there is the average vendor discount. So how much a vendor discounts their initial advertising price for the sale. So back in 2010, it was just under 10%. So just to give you an example, if you advertised your house at $500,000, you would sell it at a vendor discount of 10%, which would be $50,000, or you'd end up selling at $450,000. So that just gives you an indicator of the strength of the market. That average vendor discount now is down to 5.3%. Okay, so that's obviously an indicator of the demand for property within the Brisbane market. Something else that was really interesting that was reported by CoreLogic. For the first time ever, we're experiencing nil rental growth across the combined capital cities, and that's something that's never been seen before. So again, that's probably an indication of supply and the increase in median house price or price growth. Gross yields at the moment. Brisbane is at 4.4%, so this is gross rental yield, 4.4% at Brisbane. Sydney's down at 3.4% and Melbourne's down at 3%. So again, that just is an indication of that rapid growth in prices, I would say, in Sydney and Melbourne. So your gross rental yield at the moment is much better in Brisbane. Another very interesting point. Great data that they have at CoreLogic and some great insights they did provide. So looking at foreign investment, and this is one that always gets a lot of attention. So if we have a look at the combined capital city price growth from May 2012 to January 2016, if we have a look at that in the local currency, okay, so that's obviously taking into account the exchange rate between here and overseas. The combined capital city price growth from May 12 to January 2016 in Australia in local currency, so in the AUD, was 31.3%. Okay, so over that roughly 4-year period, we've seen price growth of 31.3%. However, if you were to convert that into Forex and having a look at someone from China and in terms of their local currency, over that time, prices have actually fallen 1.5%. So you can see just how affordable our property is for a foreign investor based in China. The other thing they also reported was that overseas buyers are now accounting for approximately 19% of apartment sales as well, and that obviously is influenced by the FIRB regulations in terms of what properties foreign investors can purchase or invest in. Just a couple more points to finish off. MFAA mentioned that 53% of all home loans are now written by brokers, so it just goes to show the strength of the broker market and having that choice and expertise available to you. Obviously a lot of people taking that up, and that just continues to grow. And the final point I just wanted to mention, this comes from the NAB survey, and I think this is really telling. They did mention the drivers of household financial stress. Okay, so what are the key drivers of financial stress for households? Number one out of all of these was financing your retirement. Okay. A couple of the others I'll mention as well. Paying for medical bills or healthcare, providing for your family's future, raising $2,000 in an emergency. Again, I thought that one was really telling. And a couple of the others, being able to pay the mortgage and being able to afford a holiday. So there we have it. That's my update from the week. Hopefully you've been able to get some good insights out of that. As I said, there were some really interesting presentations, and I'll look to bring some more of these updates to you throughout the year as well. Look, if there is anything that I can assist you with, particularly in relation to some of those those last couple of comments around financial stress at the moment, financing your retirement, which could involve purchasing potentially some investments or investment properties for your retirement, or being able to raise some funds in the short term, whether it's for medical bills, holidays, for emergency situations, any of those sorts of things. If there is anything that you are concerned about and you do want to have a chat about, whether that's financing an investment property or an investment portfolio, or if it's accessing some of the equity within your existing property and looking to refinance, get a better deal, reduce your expenses and what you're paying on your existing mortgage, please feel free to get in touch. Anytime, give me a call on 0433 994 693. Certainly happy to talk through that with you and see if there's something that we can help you with. Okay, thanks very much. Have a great day.